So some medium-term upside for new home sales, but rates, obviously, we've seen the rate back up in rates more recently. Here's a rate sensitivity table as it relates to mortgage rates. So you can see where we were highlighted in green. That's September 2017. You'd call it the latest trough at around 3.6% on the 30-year fixed rate. We're up almost 90 basis points to around 4.5% as of the latest data. You can see in the column that's on the right there what that means in terms of impact on affordability. You're down almost 10% in affordability terms if you assume.
So basically your ability to buy a $500,000 house goes to $450,000.
Right,
Yeah,
your purchase capacity, yeah. Right? So your basic rule of thumb in terms of interest rate sensitivity is 100 basis points change in rates gives you 10% reduction in affordability.
And so how is that impacting demand so far? Like, what have we seen?
It's hard to say because especially in the near term, because there's a couple of things at play. There's some short-term dynamics and some medium-term dynamics, but in the short term, sometimes when you see expedited increases in interest rates, it actually pulls forward demand, so you see demand actually go up a little bit.
Because people get worried about more increases in the future.
Right, so I'm sitting on the fence, maybe I want to do it, yes, I'm going to do it because rates are moving, so I get off the fence. Over the longer term, or over medium terms, when you look at, it affects the decision to buy less than it impacts your capacity to purchase, what you can purchase.
Yep.
And what we've seen recurrently, and we've profiled this a couple of times, we've gone over previous instances, and there's really 3 of them where you've had expedited increases in interest rates over a short period of time. There's really been 3 of them where you've seen interest rates up 100 to 180 basis points over, call it 12 to 14 month period. From a volume perspective, you see it down low single digits from where it was to the ultimate impact after you've seen the rate rise. You see from a price growth perspective, you see home price growth largely flatline. So if in the previous year you had you'd gone from up 2% year over year to up 5%, you basically see that flat line and you kind of hang out, you'd be +5%, +4%. You don't see a continued acceleration.
Yep.
So the fundamentals are modest to moderately sensitive to expedited changes in interest rates. The stocks are highly sensitive to them.
Yep.
So if you look at the builders, or really any housing-related equity exposure, you do not want to be long them.
We actually have a question on this, but a company like Lennar, you probably don't want to be long in an expedited interest rate rising environment.
Yeah, you don't. You see both significant underperformance on both an absolute and a relative basis.
Yep.
And you may even see more sensitivity where the sensitivity is highest, which is names levered to first-time buyers who may be more sensitive to those kind of affordability changes.